Welcome back. In our top business story, the Dubai Chamber of Commerce and Industry received a delegation of officials from its Saudi Arabian counterpart, the Al Asa Chamber of Commerce and Industry, to enhance the relations between the two GCC countries. During the meeting, the officials discussed some of the administrative obstacles to trade between Dubai and Saudi Arabia. Currently, the country is the Emirates' sixth biggest trade partner. Last year, non-oil trade reached 32 billion dirhams, of which Dubai's exports and re-exports stood at 27 billion, and imports from Saudi Arabia totaled over 5 billion dirhams. This shows that there is significant potential for future business growth, the Chamber's chairman, His Excellency Abdul Rahman Saif Al Ghurair, said. A wave of new houses and apartments are coming onto the UAE's property market in the months ahead, putting additional pressure on real estate prices. Home prices, which have fallen by more than half since 2008, may drop by another 10 to 30% as developers add to supply in Dubai and Abu Dhabi, Bloomberg reported. However, according to property research company CB Richard Ellis, this projection is exaggerated and only applies to some areas.
I think, we've seen some recent reports that have suggested that rates will be falling by another 10 to 13% as supply comes onto the market. I think this is actually slightly exaggerated. Certainly during the first 6 months of this year, we saw sales decline at just under 5%. We'd expect probably a similar level for the second half of this year. I think as new properties come on next year, yes, there will be deflationary pressures again in areas of oversupply, but we have already seen some stability in areas such as Palm Jumeirah and downtown, and I think you really have to look at it now on a project-by-project basis, and I think that is something is important to remember when we're looking at these kind of levels of decline for next year.
The International Petroleum Investment Company, Abu Dhabi's investment vehicle, plans to issue a dual-tranche benchmark-sized dollar-denominated bond. That's according to lead arrangers Reuters reported, for IPIC to be able to repay debt and for other general corporate purposes. The bond is expected to price later today, according to sources. Benchmark-sized bonds are at least $500 million in value. IPIC concluded roadshows in New York on Wednesday. Goldman Sachs is the global coordinator for the bond. Dubai Financial Market, the Arab world's only listed stock exchange operator, said its third quarter net loss reached 9.3 million dirhams, compared with a loss of 3 million a year ago, it said in a statement on the Dubai Bourse today. With that, let's now look at the UAE stock indices as well as those from the GCC region. In our world business news, Eurozone leaders struck a deal with private banks and insurers today for them to accept a 50% write-down on their Greek government bonds. This is part of a plan to lower Greece's debt burden and try to contain the two-year-old Eurozone crisis. Under the deal, the private sector agreed to voluntarily accept a nominal 50% cut in its bond investments to reduce Greece's debt burden by 100 billion euros. This would lower the highly indebted country's debt burden to 120% of its GDP by 2020, from currently 160%. The aim is to complete negotiations on the package by the end of the year, so Greece has a full second financial aid program in place before the beginning of 2012. The value of that package, EU sources said, would now be 130 billion euros, up from 109 billion when a deal was last struck in July. Meanwhile, the firepower of the EFSF was scaled up to 1 trillion euros, up from the 440 billion euros the fund currently has. We have Bruce Powers in the studio, head of research at Trust Securities, to discuss the issue. Welcome, Bruce. Good to have you here. Now tell us, is this 50% haircut on Greek bonds, is that okay to bear for banks, or is it a too heavy load, do you think?
Well, this is part of the reason there's several components to the new plan. If the banks don't take the haircut, they're at a high risk of getting nothing in a default. Now, to help cushion the blow to the banks and the financial system as a whole, they're going to be required to raise additional capital of about 106 billion euros in order to get their capital adequacy rates up to at least 9%, which is considered to be the kind of the minimum safe area. Now, if they didn't go along with this as a voluntary in a voluntary manner, then there's a risk that the credit default swaps would be triggered, and this is what brought AIG down. And nobody really knows how many of these are out there, and this is a form of bond insurance. So the risk of the financial system is high in that situation.
Now, the firepower of the EFSF, as we just heard, was boosted up to 1 trillion euros through a so-called leverage effect. Can you explain to us how that works?
Well, the details of exactly how they're going to do it are still not totally clear. One of the reasons they've raised the amount so much is because of concerns about debt of Spain and Italy. But there are two pieces that have been talked about. One is that they create a new fund that the stability facility seeds with some amount of money, and then they go out to China and Russia and sovereign wealth funds to raise additional capital into this new fund. The second part is they finance guarantees of defaults of Spanish and Italian debt. So this is a potential default, but they go and they get these guarantees, so they add a lot of security into the market, or the perception of the market.
Thanks for coming in. Have a good weekend. Bruce Powers. That's a wrap-up of your business news, but before we go, we will leave you with a quick overview of the oil, precious metals and currency markets, and after that we have today's sports news for you.